Hi, I'm Sachikara. Today we will solve exercise 22-25 for ROI, RI, EVA calculations, and performance evaluation. Please pause the video to read the question and then continue with the video to follow along with the solution. First requirement of this question is to calculate the ROI and residual income for each division of Lucy Manufacturing. Top part of the table indicates the information that is provided to us in the question. Clothing division has $800,000 in operating income after tax and has invested $3.2 million in assets, while cosmetics division has the operating income after tax operating income of $1.8 million and has $7.5 million invested in assets. To calculate the ROI, we know that the formula is income divided by investments. So let's calculate the ROI for both divisions. We know that the after-tax operating income for the clothing division is $800,000. So that's our income divided by the $3.2 million in investments, which gives us an ROI of 25% for the clothing division. Now to calculate the ROI for the cosmetics divisions, we know that the after-tax operating income is $1.8 million. Divide that by the $7.5 million of invested assets in that division. It gives us an ROI of 24% for cosmetics division. Now the next ask for the question is to calculate the residual income. Again, let's look at the formula for residual income, which is equal to income minus required rate of return, in short ROR, times investment. Required rate of return is same as the weighted average cost of capital, which was given to us at 11% for Lucy Manufacturing. Now to calculate RI for the clothing division, we already know the after-tax operating income of $800,000 minus the required rate of return of 11% times the investment of $3.2 million in the clothing division. That gives us the residual income of $448,000 for the clothing division. Now let's calculate the RI for cosmetics division. We know that the after-tax operating income is $1.8 million for cosmetics division minus the weighted average cost of capital, which is same as the required rate of return at 11%, times the $7.5 million of investment in assets for the division gives us a residual income of $975,000 for cosmetics division. So the second part of the first question is briefly explain which manager will get the bonus. So the choice of the measure used to evaluate performance evaluation will determine which division will get the bonus. For example, if Lucy Manufacturing uses ROI, then we know that the clothing division earned a higher ROI of 25%, and hence clothing division will get the bonus. However, if the company uses residual income to evaluate performance, then we know clearly that cosmetics division had a much higher residual income of $975,000, and hence cosmetics division will get the bonus. The third part of question number 1 is, what are the advantages and disadvantages of each measure? The advantages and disadvantages of ROI and residual income methods are listed on this slide. I would encourage you to pause the video and read these advantages and disadvantages. In the second question, we are required to calculate another performance measure, which is economic value added, or EVA for short. Top part of the table again indicates the information that's already provided to us, and there's some further or additional information that's given to us in question number 2. For the clothing division, The adjusted operating income now stands at $938,000. Already we know that the net asset investments were at $3.2 million. Additional new information that's provided, which is the current liabilities of $520,000. So for us to calculate the investments, we now have to take the net assets less the current liabilities that are provided as part of question number 2, which stands at $2.68 million, which is $3.2 million of net assets minus $520,000 of current liabilities, and hence the investments are now at $2.68 million for the clothing division. For the cosmetics division, the adjusted operating income, as per question number 2, is $1.1472 million. From the earlier information, we know that the cosmetics division has a net asset investment of $7.5 million. And now, with the additional or new information that's provided as part of question number 2, we know that their current liabilities are $330,000. Hence, the investments for cosmetics division is now at $7.17 million, which is net assets of $7.5 million minus the current liabilities of $330,000. So net assets or investments for cosmetics divisions now stand at $7.17 million. With the adjusted operating income, we need to calculate the revised ROI for Lucy Manufacturing. Again, the formula is income over investment. So for the clothing division, income of $938,000 divided by the net investment of $2.68 million gives us the revised ROI of 35% for the clothing division. Looking at the cosmetics division, we know that the adjusted operating income now stands at $1.147.2 million. Divide that by again the investments of $7.17 million. That gives the adjusted or revised ROI of 16% for the cosmetics division. So focusing our attention now to calculate the economic value added performance measure, the formula is after-tax operating income minus weighted average cost of capital times total assets minus current liabilities, which is basically our investments. So for our clothing division, our after-tax operating revised income is $938,000 minus 11% of weighted average cost of capital times our net investments of $2.68 million gives us actually an EVA of $643,200 for the clothing division. Similarly, for the cosmetics division, our after-tax operating income of $1,147,200 minus the weighted average cost of capital of 11% times our net investment of $7.17 million results in an economic value added measure of $358,500 for the cosmetics division. So in conclusion, if the CEO of Lucy Manufacturing introduces EVA or economic value added as the performance measure, then it is quite clear that clothing division, which has the higher EVA of $643,200, will receive the bonus. Question number 3 for this particular exercise asks us non-financial measures that Lucy Manufacturing can use to evaluate divisional performances. And below you will find some of the suggested non-performance measures for Lucy Manufacturing.